So we know when we bring something into the accounts, when it meets the definition, when it's probable, and when there's a reliable measure. But what about this definition thing then? So let's have a look at this. Definition of an asset, okay? Keywords, it must be controlled. Notice that's not owned, faithful representation. It must be controlled by the enterprise as a result of a past event. Okay, so as a result of a past event, and that you've got future benefits expected. All right, and they're the three things that you remember for the definition of an asset. Definition of a liability then is you must have an obligation at the moment, so a present obligation. Now that obligation could be legal, or it also could be just something that's expected of you. Okay, so again, this present obligation must come from a past event, and that there must be an outflow expected. Probable outflow, isn't it? So an outflow expected to happen. Okay. Equity is basically assets minus liabilities. On to income. Income is an increase in assets. So when assets goes up, you've got an increase, or it's a decrease in liabilities. And similarly, an expense is a decrease in your assets or an increase in your liabilities. So can you see that we're taking a balance sheet perspective here, because we're defining the assets and the liability first, and then the definition of income and expense comes from that.